If you are watching the silver market right now, and you are confused, frustrated, or even angry, you are not alone, but you are also looking at this move the wrong way. What you are seeing today is not a breakdown in the silver bull market, it is not a failure of the thesis, and it is not a sudden collapse in demand. What you are witnessing is a forced mechanical liquidity event driven by year-end banking regulations, capital requirements, and balance sheet positioning. Silver trading down near $70 after recently trading above 75 is not a signal of weakness. It is a signal of stress inside the financial system. This is not emotional selling. This is not retail panic. And this is not fundamentals changing overnight. This is large institutions acting under regulatory pressure as the calendar forces them to clean their books before December 31st. On the final trading days of the year, banks do not think like traders. They think like accountants. At midnight on December 31st, regulators take a snapshot of every major bank's balance sheet. That snapshot determines capital ratios, systemic risk scores, and how much cash those banks must hold for the next year. Assets like silver, gold, equities, and bonds increase balance sheet volatility. Cash reduces it. So when banks approach year-end with large exposure to volatile assets, the incentive is simple: reduce risk on paper, raise liquidity, and show maximum cash. That means selling. It does not matter whether silver is undervalued or overvalued in that moment. It does not matter whether demand is strong or weak. The rulebook overrides market logic. This is why silver and gold are falling together. This is why bonds are selling off at the same time. This is why the US dollar spikes during these events. It is a dash for cash, not a vote against precious metals. Basel regulations and G-SIB scoring force banks to temporarily sacrifice price stability in order to protect their capital ratios. When liquidity is thin, as it always is during holidays and year-end, even moderate selling creates exaggerated price moves. That is exactly what we are seeing now. A relatively small number of futures contracts dumped into an illiquid market can move silver several dollars in a single session. This is not price discovery, this is price distortion. Understanding this distinction is critical, because investors who confuse liquidity events with trend reversals make the worst decisions at exactly the wrong time. The silver market is particularly vulnerable to these moves because it is small compared to gold and equities, and because a large percentage of trading volume is paper-based. When banks sell futures contracts to reduce exposure, the paper price collapses far faster than the physical market can respond. This creates a disconnect between spot price and real-world availability. While the screen price shows $70, physical premiums remain elevated. Dealers do not lower prices because they understand the selling is artificial. They know replacement costs will be higher once the calendar flips. That behavior alone tells you everything you need to know about whether this move is real. If this were a genuine demand collapse, premiums would compress. Instead, they are expanding. That is a textbook signal of a paper-driven sell-off. At the same time, industrial users see this dip not as a warning, but as an opportunity. For manufacturers that require silver as an input, a temporary price suppression is a gift. They are buyers, not sellers, at these levels. That demand creates a natural floor under the market. Historically, these year-end sell-offs resolve quickly once regulatory pressure is removed. As soon as January begins, the incentive structure flips. Banks are free to redeploy capital. Funds receive new inflows. Pension allocations reset. The same institutions that were forced sellers in late December often become aggressive buyers in early January. This is the foundation of the January effect, and precious metals are among the most sensitive assets to this dynamic. The technical damage on the chart may look severe, but technicals divorced from context are dangerous. A sharp drop during illiquid conditions does not invalidate a larger trend. It resets positioning, it flushes leverage, it transfers paper exposure from weak hands to strong hands. When silver tests major support levels during these events, what matters is not how fast it fell, but how it behaves once selling pressure exhausts. Volume patterns during the drop indicate absorption, not abandonment. Buyers are stepping in quietly, allowing forced sellers to exit without chasing price higher prematurely. This is how durable bottoms form. It is uncomfortable, but it is constructive. From a macro perspective, nothing about today's move changes the structural case for silver. Global debt continues to expand. Fiscal deficits remain unresolved. Monetary authorities remain trapped between inflation and instability. Industrial demand for silver continues to grow due to electrification, solar, and technology. Mine supply remains constrained. None of these factors reverse because of a December liquidity event. The only thing that changes is price, and price in the short term is governed by flows, not value. Investors who understand this distinction position themselves ahead of the turn instead of reacting after it. Another layer adding pressure today is tax loss harvesting. Funds that hold positions showing losses into year-end are incentivized to sell in order to offset gains elsewhere in their portfolios. This selling is calendar-driven, not conviction-driven. It disappears instantly once the tax year ends. The result is artificial weakness that often reverses violently in early January as those same funds re-establish positions. This pattern repeats every year across multiple asset classes, and silver is no exception. When you combine regulatory selling, tax-driven selling, thin liquidity, and algorithmic momentum strategies, you get exaggerated downside moves that feel catastrophic in real time but look insignificant in hindsight. The worst mistake investors make during these periods is extrapolating short-term price action into long-term conclusions. The market is not telling you silver has failed. It is telling you liquidity is temporarily scarce. The US dollar rally accompanying this move confirms that interpretation. Dollars are being hoarded, not because the economy is strong, but because balance sheet rules require it. Dollar strength driven by liquidity stress is temporary by nature. Central banks respond to dollar shortages with liquidity injections. Repo facilities expand. Financial conditions ease. When that happens, the dollar retreats and hard assets rebound. Silver is not collapsing in isolation. It is being compressed by the mechanics of the system. Once those mechanics relax, price normalizes rapidly. The psychological challenge during these moments is significant. Watching price fall after a breakout feels like betrayal. But markets do not reward emotional consistency. They reward analytical consistency. If your thesis was based on systemic risk, monetary debasement, and structural supply constraints, none of that has changed. If anything, the violence of these moves reinforces the fragility of the system silver is meant to hedge against. Volatility is not your enemy. Misinterpretation is. The correct response to a liquidity-driven sell-off is not panic. It is preparation. Preparation for what happens when forced sellers finish selling. Preparation for when capital flows return. Preparation for when suppressed prices meet renewed demand. This phase is not the end of the move. It is the reset that allows the next phase to begin. Now let's move deeper into what actually matters after a move like this, because understanding the recovery mechanics is far more important than reacting to the crash itself. When silver experiences a sharp, liquidity-driven sell-off into year-end, the first thing professionals look at is not the candle size, but the structure underneath it. The key question is whether the selling was value-driven or obligation-driven. Everything we are observing points to obligation-driven selling. That distinction changes the entire forward outlook. Obligation-driven selling creates air pockets. Once the obligation ends, price moves rapidly to reprice risk. In silver's case, the obligation ends the moment the calendar flips and regulatory snapshots are completed. That is why January 2nd matters. That is why the first full trading session of the new year carries disproportionate importance. This is when suppressed assets reconnect with demand. Technically, silver breaking down from the mid-70s to the low 70s feels violent, but structurally, It remains within a healthy correction zone relative to the broader move. Markets do not move in straight lines. Strong trends require resets. Leverage must be flushed. Weak positioning must be removed. This event did exactly that. Momentum traders were stopped out. Late entrants were